So thank you everyone for joining us today for what I've called the new construction conversation. We're going to talk today briefly about the different types of new construction, but then also dive deeper into the financing and how that works for new construction. And so to help me with this new construction conversation today, I have Joshua Rubin here with me. Joshua is the founder and president of Horizon Financial Group Incorporated and has been the top 1% loan originators since entering the business in May of 1995. He's done over 1 billion in closed loans. He has a degree in finance and attended Michigan State and Eastern Michigan University. Joshua is committed to making the loan process as simple and clear as possible and ensuring that his clients' unique needs are met at the lowest costs and rates. So thank you, Josh, for being here. Greatly appreciate it.
Thanks for having me. You make me sound really old, but that's okay.
Well, you must have been 18 or something, I guess, when you got started.
Good genes.
Oh, 15?
Yeah.
Oh,
No, I
wow.
wasn't 15. I was a young man, let's put it that way.
Okay. Yeah, because I did hear someone that a lender that I think he said he started at 16 as an agent and then became a lender. So wouldn't be surprised. Okay. So for those who don't know, there's different types of new construction. Most people are looking to get the spec home because that's the simplest process, I would say. That's where the builder is already going to build a community of homes and they will be built no matter when someone's looking to purchase them or not. And a lot of times you can kind of, depend on when you come in the process, you can pick out your lot even, or if you're coming at the end of everything, then you're just picking out maybe some colors and some other finishes. The next level would be when you are, maybe let's say it's called to be built, where the builder already owns a lot of land and they are actually waiting for a particular buyer to be ready to start building on that lot. It's not like a brand new community most of the time. It's just they have a lot that they purchased, they thought would be a great deal. And so they may have some different plans for you and options on what they're going to build. And you have kind of like your semi-custom where you would pick out different floor plans. Let's say you may already own a piece of land, or you purchase a piece of, you're going to purchase a piece of land, or the builder's purchasing that land for you. But at any rate, you're just picking out different floor plans that they already have in mind to build on that lot. And then the most expensive, the most lengthy one would be when it's truly custom. So you're getting that initial lot that you really want to buy. And then every detail is customized to exactly how you want it. But of course, no home is perfect. So even if you do that, it won't be 100% perfect. So hopefully now you can have a big understanding of the wide range of different new construction options for you. And so how does financing differ for new construction in these different ways?
Great explanation. So if you have a house, the community that's being built by a builder, generally they'll self-finance, meaning the builder is going to finance that. What they'll require is generally a deposit from the borrower when they sign the contract, and then there are payment schedules that the buyer will make at predetermined spots, like when the basement's dug, when the house is framed, when the house is roofed, when it's drywalled. That money that they give them over the course of the transaction acts as their earnest money deposit. So they give the builder that money, usually about 90 days ahead of time is when we'll get involved, where we'll turn around and get the buyer approved for a mortgage, similar like they would if they were just buying a house that was already constructed. Same terms, they're not paying any more. They can put as little as 5% down. It's just a 30-year fixed if they care to, or even a shorter term. The only difference between that and an established build is just that it's new construction. Now, the other one that you explained is an actual construction loan. That happens more when it is a custom build, whether the builder owns the land or whether the buyer owns the land. They are going to take out a construction loan to build their home. That is definitely a little more involved. We have great programs for that. Again, it can be as little as 5% down. What happens in that regards is that over the course of the transaction, the builder requests those funds. The title company then disperses those funds, what's called on a draw schedule. The builder can only request a draw for work that's already been done or material that's on site. And they do that so the builder's not getting his until the house is complete. So if it was like $1 million construction loan, for example, it's not going to be $1 million on day one. The buyer only pays for what they borrow. So if the initial draw, let's say the builder needs 100 grand for plans and for permits and infrastructure, then when that borrower gets that first bill, it's only going to be for the $100,000 that they borrowed. They have the ability to borrow up to, let's say, $1 million in that case. Anytime the builder needs funds to continue constructing, they make a draw request of the lender. The lender disperses those funds to the preferred title company. The title company then cuts those funds directly to the builder so that the construction can continue to be onward.
If you've enjoyed watching this video and would love to stay up to date when I have more content like this or something similar that you may be interested in, please like and subscribe to this channel and click the bell so you get notifications. And I hope you have a great day. Thank you. And I think you kind of briefly talked about it in that response. A lot of times it'll require a fee on spec homes just to reserve the lot, and it can be, several $1,000s to hold property, and the buyer may have just a few days to decide if they're going to proceed or not. But if they proceed, I'm assuming that, so it sounds like that becomes not only the buyer's earnest money deposit, but can also be their down payment. And it's often the difference from when existing homes, you usually put in your earnest money deposit with the purchase agreement or after. In this case, they're giving that before they even see the purchase agreement. But of course, all bills have different terms on the deposit amount, must be, and other details. Is that right?
Yeah, that's correct. And so it's actually a construction loan agreement. I'm sorry, it's a construction agreement between the buyer and the builder. So like a purchase agreement, but it spells out those terms. It's going to have it's going to request EMDs or deposits, which acts as the borrower's down payment. One thing that they might do, so the builder is definitely going to require a pre-approval at that time to make sure that they're going to build a home that's going to be able to get closed on. That may happen 6, 8, 9, 12 months before the house is actually complete. So that's when we get involved for mortgage pre-approval. We don't actually start the mortgage process until we're about 90 days out.
So I get a lot of buyers that they want to do new construction because it sounds great and favorable. But a lot of times they don't end up doing it because of the timeline or the increase in price square foot, meaning, let's say to build the home is 2,000 square feet, but a home that looks exactly like it that was built 50 years ago is going to be a lot less than the new construction home. So what is a realistic timeline a buyer can expect a new construction mortgage process should take in comparison to an existing home? And I guess, of course, that would depend on the kind of new construction they're getting. But
let's just assume in that regards, the buyer is well qualified. A construction loan itself can take upwards of around 40 days to close. It can be less than that, but that's on average. The reason for that is because the lender is also going to approve the builder. So there's information that they require from the builder, that he has workers' comp, that he has builder's loss. There are certain requirements that the builder needs to have because they have to be a licensed builder. It can't be like your Uncle Joe or anything else across the board. Like, it has to be somebody who is vetted and approved. That takes a little bit longer. It's not anything that the builder's not used to. They've gone down that path before. If it's new construction, but the buyer is not taking out a construction loan, again, we'll pre-approve them up front. We get started in earnest about 90 days out. The only reason why we start that long ahead of time is so that we can get an appraisal ordered. Because in most of these construction contracts, and this is important, it spells very clearly that the buyer is going to pay that purchase price regardless of the appraised value. It didn't used to be that way, but the builders do that so that they know first and foremost what they're going to be getting on that transaction. But it also, think about it, it creates comps. So if you have a community and you have a price that is guaranteed to be purchased at that, you are now establishing the market for that community. So it's good for the builder to continue to be able to market that community, knowing that those prices are set and that they're getting their full purchase price no matter what. When we do get those appraisals ordered, the appraisal will come back subject to plans and specs. So it'll give us a value based if the house was completed. Then what happens is that prior to close, usually a day or two, the appraiser will go back out and do what's called a 1004D, where they'll turn around and they'll verify that the house is completed per the plans and specs. Generally, that's an at-close condition and won't hold up a clear to close. But that's how it's done because these builders have a very set timeline. Especially some builders, they can tell you 9 months out when the house is going to be complete and that given day, and they absolutely will complete it on that given day. There's not a lot of times for where a buyer can delay the closing or otherwise. It's all very regimented and it's all very process driven. So that's why the last step is for the appraiser to go back out and verify that the house is actually completed. That usually happens once the C of O or temporary C of O is issued.
Oh yeah, and so that's one part I didn't talk about. So C of O's. Um, you want to talk about how certificate of occupancy is required for new construction and why?
Yeah, the reason why it's important. So some communities, again, the builder's pulling permits, it's getting inspected every step. So when there's drywall, when the basement's poured, at all these certain steps, the community in which the house is being built, the building department will come in and they will sign off on the work that's been done. And that's very important, obviously, because that prevents any mechanic liens down the road or otherwise. But what will essentially happen is that once the house is completed or ready to close, then a temporary C of O or a C of O will be issued a certificate of occupancy. In new construction loans, the lender will require at least a temporary C of O prior to close. The only reason why it might be temporary, if let's say it's the time of year that it's the winter, they may not be able to pour a cement driveway. There might be sprinklers that still need to be done. There might need to be landscaping, final grading. Those are the sort of things that would still allow the loan to close on a temporary C of O. And then once the weather changes or otherwise and the work is finished, the title company generally will hold on to funds so that they can guarantee that the work will be done. Then once that's all done, then the inspector will go back out, sign off on it, issue the C of O.
Okay. So a lot of times it's been explained that when buyers get a new construction loan, draw a loan, a true new construction loan, essentially that's refinanced into a regular mortgage once the home is built and our parties are ready to close. But it sounds like for you, it's not really that way.
It's a one-step close. So what happens is that, and this is actually nice depending on what's going on in the rates. The way it works is that the rate on that construction loan is going to be the same as when the house is complete. It's the same loan. It just gets modified from a construction loan to permanent financing. If rates are higher at that time, you're safe. You already have that rate locked in potentially 6, 8, 9, 10 months earlier. If rates are lower, what happens is the loan converts to that end loan, and then the borrower can turn around and refinance that to a lower rate if they choose to. It's a regular loan. The only difference is during the course of construction, as the borrower is borrowing money because the builder is requesting it, you only pay interest only on that. You don't pay fully principal and interest. You just pay interest only, which also keeps the carrying cost down for the borrower over the course of construction. And they're not even going to borrow the entirety of what they are approved for loan-wise until they get close to the end of the process. And again, the reason for that is because the builder, when he requests a draw, it can only be for work that's already completed or material that's on site. So it takes a minute before you get to that final loan amount. It's generally towards the end of the process.
Okay, so yeah, a lot of times the builder requests the buyer get pre-approved with their lender, but of course the buyer can still choose whichever lender they want. What would you say are some of the biggest advantages of the buyer using their own lender of choice over the builder's lender?
So you are correct in that regards, and that's just the builder has relationships. They're going to choose the title company. They may have a lender they're comfortable working with. Just like in any other property, if a listing agent required a buyer to get approved by a particular lender, the buyer can do that, but they're not obligated to use them. They're just simply doing that to make obviously the seller or the builder more comfortable. There are advantages to using the builder's lender. I'll be absolutely frank and upfront about that, especially as houses are sitting a little longer on the new construction side. Because the fact that the builder doesn't want to lower the purchase price, many times they will offer incentives to the buyer if they use the preferred lender. In some instances, it could be seller's concessions. It can be 2-1 buy downs. They can be large incentives to incentivize the buyer to use the preferred lender of the builder. that helps to keep the pricing stable, where the builder is not lowering the price, but it is an actual benefit to the borrower. And I'd be remiss if I wasn't clear on that. Doesn't happen every single time, but there are times when I will tell a client, depending on what the builder's lender is offering them, that it might be a better deal, even though it cuts me out. It might be a better deal for the borrower to use the preferred lender just because of the incentives, even if it means a higher rate, even if it means more legwork, what have you. Because those incentives are in place, many times those are difficult to beat.
Okay. Some buyers don't realize that I'm choosing not to have a realtor involved in buying new construction home. It's equivalent to buying a home with the listing agent or the seller directly, who is not obviously looking out for their best interest, looking out for their own interests. And just like you said, if you're using their lender, their title company, they've got everything. You're just a customer. And some people think it's okay because it's a new home, but at the same time, and they're building a new home that hasn't existed before. And I think people don't think about that part. So at least if they at least have their own lender, they do have some form of representation. What are some of the major differences you've seen when a client has a realtor buying new construction when they don't have one?
Yeah, the builder will pay the commission to the buyer's agent. So like if a buyer's agent finds a property and they have an agreement in place with that borrower, as far as what your compliance purposes are, the builder will actually pay the buyer's commission. We always say, like, if you have a dual agent, so if the sales agent that represents the builder is the only one involved in the transaction, whose best interests are they really looking out for? So that buyer really doesn't have an advocate. The other advantage to having a realtor when you buy a house, there are certain things that the builder pushes back on the borrower. Like, I'll give you an example. Generally speaking, on any transaction, the seller is always going to pay an owner's policy for the benefit of the buyer to ensure that they're buying a house that's free and clear of any liens or encumbrances. When you have an owner's policy on a new construction and it's written in the contract this way, many times the owner's policy will only be based on the value of the land, not on the value of the house, which keeps the cost down for the builder. Many times the builder will make the buyer pay for the owner's policy. And then the big one, and this is huge, transfer taxes. So again, in Michigan, normally the seller will pay the state and county transfer tax. On almost all new construction, they'll push that back to the buyer. So if it's $8.75 per $1,000 and it's $1 million purchase price, that can be an extra $9,000 that buyer is paying for on behalf of the builder because it's new construction.
Yeah, I did have some buyers that always bought new construction. Maybe they bought 3 homes before, and then because they had a family member here, they used me to new construction. And they said they would never buy on their own again. So that definitely says a lot. But so what if a buyer wants to buy the land first that the builder doesn't own, and then build later, even possibly a year or 2 years later?
Okay. Yeah, that would be called a lot loan or a vacant land loan. We do those. Generally speaking, it's a 20% down payment. The rate is definitely a little higher. It's probably about a point to a point and a half higher than what it would be if there was a house on that actual property. It acts just like a buyer is buying a house, except there's no house. It's just land. And the term of that loan, it can be 5 years, it can be 10 years, it can be a 30-year fix if you wish. The buyer just makes the payment just like normal until they're ready to build on it or sell on it or use it or what have you. A lot of banks won't do lot loans, so it's a nice niche that we have because of the fact that there might be a great deal on land, or they might buy land up north to build on, but they're not ready to build. It's a good way to not have to tie up a ton of cash to be able to finance that as a traditional lot loan or vacant land loan. One thing that you would mention was good. So a lot of times the builder may own the land. If the builder owns the land, that's built into the purchase price. So he might be selling the lot for $150,000. The new construction cost might be $650,000. The purchase agreement is going to say $800,000. So when we're talking about a 5% down payment, it's 5% down of the entire acquisition cost. So the price of the land plus the construction costs. Why that's important is because you're not buying the land separately. It's all built into the purchase price so that they're able to finance it either with end loan financing or with a construction loan. You mentioned something earlier that in some instances, the builder will buy the land. That would be the advantage for a buyer, is that it's built into the purchase price. If the builder doesn't own the land, in many instances, the buyer has to pay cash to buy the land and then turn around and have the builder build the house. Many times they're not financing that lot like they normally would, because this is important. Let's use your example. A client buys land for 100 grand, 5 years ago, and now they're ready to build on the house. If there's a mortgage, if there's a lot loan, the very first draw on the construction loan goes to pay off whatever's owed on the lot. Like the construction loan is in the first lien position, just like if it was an established house. So that factors in, though, into what the amount that somebody's going to finance on a construction loan. If there's a mortgage on that land, that includes that. The advantage to that, okay, is the value of the land can act as a down payment. So if they paid $100,000 for it and now it's worth $200,000, okay, when you do construction loan financing, again, it's the total acquisition cost versus the as completed value. So in that same example, if the land is worth $100,000 more than what they paid for it, that can actually act as a down payment for the borrower. So if it's a $1 million construction and they have land that's worth $200,000 and they owe $100,000 on that, in reality, they already have 10% in the transaction. So in that example, they'd be borrowing $900,000 versus $1 million. It's a benefit to the borrower either which way. Just some people are not in a position to pay cash for the land up front.
Yeah, because that can be, I've come across those a few times too, where it's a little tricky because ideally you want to be able to do everything all at once, but if you can only buy the land, you gotta start there. But at the same time, what if you buy the land and you're never ready to build?
Now, the other thing I'll suggest is that if a client already owns the land and they want to build, they're the ones who are going to find the builder. They're the ones who are going to hire the architect for the plans. A lot of that happens before even the construction loan financing. And the reason for that is because us as the lender have to know what the final numbers are. And so when it is a construction loan, there is a couple important pieces. One of them is called the sworn statement. It's kind of like the Bible. It spells out chronologically when things are going to be built, how much they cost, what the amount is, and it literally goes down the list of building a home. The lender requires that sworn statement because that's how they're going to base what they're going to lend on and what they're going to give draws on. Now, I said something earlier about a mechanics lien. So anytime that that the builder requests to draw, the title company is going to request what's called lien waivers. So if that builder is the contractor and he's hiring out all of his subcontractors for the actual construction, if the builder doesn't pay the subcontractors, then that subcontractor could put a lien on the property called a mechanics lien. So in order to protect the lender, to make sure that they're always in the first lien position, the title company is going to require these waivers, these lien waivers, anytime there's a draw, and they're using the sworn statement to establish what work has been done. The builder's documenting that this was how much it cost, this is what we paid. So again, that there are no chances of mechanics liens down the road once the house is constructed.
Yeah, it's another good point. Where are we? Okay. So I think you already talked about it, but I said, I asked anything, I guess anything else you want to add to this, but how do you feel about the builder purchasing the land on behalf of the buyer? And then the buyer gets a new construction loan, they purchase the land from the builder once it's completed.
This I haven't seen it often. A lot of times, like if the builder owns the land, obviously he's going to turn around and market that land to build on it. I haven't seen it happen often where the builder will buy the land up front. It certainly is a benefit to the borrower in many instances because the borrower is not having to buy that. If the builder already owns the land, it's built into the purchase agreement like we talked about. I have not yet seen where there's a plot of land, the builder buys that land, then they do a construction agreement to build a house on that. I have not seen that yet. Sounds like it would be very fruitful for the borrower if that's the case, but it's not something that I've seen over the course of my 3 decades. It's not anything that I've seen very often.
Yeah, for me, it's just been like something that's brought up. And then the other flip side is like, okay, what if you, for some reason, choose a bad builder?
Mm-hmm.
And you're like, oh yeah, I want to get this land, I want to do this. And like, okay, I'm going to buy it for you, whatever, we'll get started. And then for some reason, they got a buyer that wants to build even, you know, a bigger house, and they're like, oh, I'm going to use this buyer instead.
Yeah,
But at the same time, you know, depending on that agreement, I mean, they did buy it. So
that makes sense. They own the land. Yeah, I think that that's probably done only in very rare instances where something that like that happens. You know, for a lot of borrowers, going the community route is great, meaning that they're buying in a subdivision. It's a well-known builder. They've built, you know, thousands of houses. They're very process driven in regards to how it works. In my opinion, if you're not building a custom home, that's the best way to buy a house. New construction wise, I should say, is just giving money over the course of time on that schedule, which acts as your down payment. So in fact, if somebody were to put down money over the course of the transaction, let's say they only wish to put down 5%, but they've already given the builder 10%, that buyer can actually get the difference back at close. So if they're getting some of their cash back. Yeah, the minimum to put down when you're either new construction or if it's you're doing what's called construction to permanent, the minimum you have to put down is 5% of the total transaction. So if the land is included in the construction costs or X, it'll be 5% of that total amount.
okay. So you talked about some of the benefits, but what other benefits would you say there are for um financing new construction home compared to an existing home?
Sure. So the number one reason why somebody would build a home, besides they get to choose what they want, if they want a first floor master, you're building equity. I mean, so literally, the whole theory behind building a home is that it's going to be worth more money the minute it's completed versus what you paid for it. And so that's the main advantage to new construction. I'll also suggest when you do construction lend financing, there's something called the as completed value. So there's the purchase agreement or the construction agreement spelling out how much the builder is selling it for. Okay, this is really more on a true construction loan on a custom home. What happens is that when the appraiser is doing the appraisal off of plans, because there's no house. So they're turning around, and at that stage of the game, they will from that perspective. I'm sorry, I lost my train of thought.
Sorry, yeah, I've never seen it before. Go ahead.
Yeah, no, makes sense. No, I can't recall what I was saying, but it'll probably come back to me and I'll blur it out.
Yeah, I was trying to pick up where you left off, but I can't. I know we're talking about benefits of financing new
Oh, I
construction.
got you. As
Okay.
completed value. So what happens is that on a new construction build, the appraiser is actually doing the appraisal based off the actual blueprints. We have to get copies of the blueprints to send to the appraiser. So their construction agreement might only be $1 million, but when the appraiser does the appraisal, that as completed value might be $1 million too. I'm just making up numbers here. In that regards, the borrower already has equity in the property. It's already worth $200,000 more than what it's costing them to build that house. That difference can act again as their down payment. You know, if they have to have 5% in the transaction, but they have a house that's worth more than what it's costing them to build, that equity is real, and that can act as their down payment. It's one of the advantages of building is that you're buying equity essentially. The house is good and should be worth more money when it's built versus when you pay for it.
Makes sense. Oh, that was the next question. So you did talk about appraisals briefly, but anything else you want to add to like how the buyer can feel comfortable that, you know, there won't be any major appraisal issues when there aren't any recent sales to compare to new home? Like maybe they are the first ones to build in that community. And the upgrades are chosen are reflected in the purchase price. So maybe the base price is 400, and when they're all said and done, all the upgrades have gone to the 500.
So what happens in a lot of cases, the builder will require that those extras to be paid outside closing, not like parking lot transactions, but paying cash instead of financing it. So that does happen a lot. If the base model in a community is 400,000, you know, buyers got good taste. And when they go through and they customize that new build, just like you said, the price of that construction might go up considerably. If there's not comps in that community to help support that value, one of the things that a builder will do is that they will require that any of those upgrades are actually paid in cash and not financed, so that the appraised value is not in danger. So it's still likely to come in at that purchase price. there may not be houses that support a $500,000 as completed value. That's why a builder would do that. And one of the ways they protect themselves is that the buyer would be paying for those upgrades in cash outside of closing. It's all documented in that regard. It's just not being financed in the actual loan or any lending that they're doing.
Yeah, so basically, they just need to be prepared for that at the end of the day. And
the biggest thing I'll suggest to people who are considering building houses, really take the time to look at that purchase agreement. It is a construction agreement. There are definitely some significant differences whether they were looking at a house that's already built and been around for 20 years versus new construction. Owner's policy is huge. Transfer taxes are huge because those are hidden costs that a buyer may not be aware of until they get deep in the process, and that could add up to thousands of dollars if they're not careful.
So I had another question, which I think will be better than this next question, before we get to the next question. So as far as taxes go, right? When you're talking about doing those upgrades as well,
Yep.
now the value's higher and then your taxes are going to be higher. Some people have said, okay, well, maybe it's better for you to just do lower upgrades and change them later, but most people don't want to have to do all that. They want to move in and be ready to go. What are your thoughts about, keeping in mind, okay, the taxes, most likely will be higher once I'm done with everything?
That's a great question, something we definitely should hit on. So when a lender is, anytime you're getting a loan on new construction, even if the house is already built and it's just new construction, an escrow account, or for qualifying generally, is going to use the current year's verified taxes. In many instances, it's dirt. So the taxes might be, $1,000 versus what it will be when the house is completed. So what lenders require is us to get what's called a tax cert from the title company, or there's a state of Michigan property tax estimator that has all the millage amounts for every community. So you answer a few questions and it kicks out what those taxes will be once the property is fully assessed. And the lender will require that because they'll use those figures for qualifying for debt to income. They'll use those figures for what the escrow account will be. That's another huge thing for a client to pay attention to because every community has their own millage amount. And so if the taxes in that particular community, whether they are school taxes or otherwise, their payment could be significantly higher than what they're budgeting. And it's better for them to know that on day one versus when they get that escrow shortage or tax bill the following year, and all of a sudden their taxes are 10 grand versus 2 grand.
Yeah, it's a big difference. Okay, and then I thought I had on here, but I guess I didn't ask a question. As far as like other downfalls with new construction, what would you say are the bigger things?
I would say one thing and this happens even in houses that are already built, but that punch list item. So like when right before closing, when the buyer does the final walkthrough, there could be things that aren't finished. There could be things that are still required to be done. There could be there could be holes in the drywall, stuff that happens just over the course of normal construction. So most respectable builders, obviously, they're going to protect themselves and the actual buyer so that there's a punch list of items that will get, it won't prevent a closing, but it ensures that the borrower is going to get those items corrected once they own the house. That is really important. So essentially, one disadvantage is the fact that if there are these defects and the builder doesn't fix them, then you're in a situation where the buyer potentially is on the hook to correct those. Doesn't happen. Most respectable builders will have that punch list. They'll have a building supervisor. They'll be mindful of what needs to be done, and they'll correct it. Even when there's serious defects, most respected builders will turn around and correct that over the course of time if it's something that happened during construction.
Yeah, and I know so their rate is locked in, right? But let's say, because a lot of times new construction isn't done in the time that they say it's gonna be, unless it's like a big builder, and if the time is off, it's very short-lived, right? But let's say you're planning for 8 months and it turns into 2 years, or something happens, we have to shut down, right? Can something happen in between that timeline where the rate is no longer locked and now the buyer's in position to pay with a higher interest rate?
So generally speaking, so the rate is locked in at the time the construction loan closes, which could be before the shovel is even in the ground. So okay. that rate, that loan, the buyer knows exactly what they're going to be paying. when all said and done. This is a one-time close transaction. So the buyer is qualifying upfront for what the house is going to be, what the payment's going to be once it's completed. Generally speaking, you don't really see many issues with that. There used to be a two-time construction, okay, which used to be traditional, where you would close on the construction loan, and then once, in fact, the house is completed, then you would turn around and actually have to take out an end loan. The disadvantage of doing it that way is that you're up against current market conditions. So if your construction loan is at X over the course of construction, rates go up over that time frame, then you turn around and you're in a situation where now the buyer is paying a higher rate on their end loan because that's just where the market is. Generally speaking, those have kind of gone away because the other issue you run into when that happens, let's say a buyer qualifies for the construction loan up front, but God forbid they lose their job during the transaction and they can't qualify for the end loan at that point, that's problematic. And so the one-time closing really kind of nips that in the bud.
And what would you say the time difference was when doing the old way versus the one?
So it's most lenders will allow 12 months for construction lending, meaning that they'll give you a 12-month term to be able to build a house. Some shorten it to 9. There are some lenders that will allow you to request extra time. A lot of it depends on the scope of the project. If it's a massive house that's being built that is custom, that year time frame probably is not going to be accurate. But most homes, absolutely from beginning to end, are going to be a year or less.
Yeah, well, that's good that you said that. I meant more so when did the one time versus when it was you had to switch to an loan. When did that stop?
Oh, I would say it's become more prevalent to have a one-time close. I'd say over the last decade or so.
Okay.
A lot of things changed, obviously, in the mid 2000s. When we had that recession, definitely things changed lending-wise. So I think that at that stage of the game, you saw more one-time closings because it protected the buyer, but it also protected the lender. The lender's not going to be they don't want to own the house. God forbid the builder can't finish the home, because of financial difficulties or otherwise. That bank is that the lender's on the hook that they need to turn around and find a builder to complete the house per the plans and specs and sworn statement. Nobody wants to deal with that. So the one-time close really solved that problem. It also makes it better and easier for the borrower and for the lender.
Okay. So barndominiums are a new thing and they become very popular, which in short terms essentially is just an expansive barn that people want to live in. So does financing needs for new construction work differently?
It does. So you used to not be able to finance those. Now you certainly can. So a barndominium really, it's kind of it's like a really upscale. It could be like, it's not technically a barn. It could be more like like a pole barn essentially, but it can be really upscale, really nice. So like on the down below you could have the ultimate man cave garage, your cars, this, that, or the other, and then above that you could have like the killer living suite. There is absolutely financing products for that for new construction. It's becoming very popular, and I think you'll continue to see that moving forward. So probably about 2 years ago you couldn't even finance those. Like it just wasn't a property type that these lenders were prepared to be able to handle. Now we absolutely have barn-dominium financing. It's not even niche financing. Like most construction loans will allow barn-dominium lending.
Okay. Well, that's pretty much whatever I had for you. Do you have anything that you want to add specifically?
No, I think you hit on it. Great questions. Definitely wide breadth, which is good. A lot of information to get out there. I always appreciate the opportunity to sit down with you. You do a great job.
Thank you. And so if anyone's looking for new construction or any type of loan, how can they reach out to you?
I always say my cell phone, 248-797-5206 or horizonfinancialgroup.com.
All right. Well, thank you so much. Hope everyone learned a lot today and hope you have a good day.
Thanks, Patrice.
Thanks. Bye.